please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to the budget special episode of Big Deal. Now remember, lots of big announcements have come in the union budget. A lot of them could really ease deal making in the country, and a few of them would require clarity. There's a whole host of things that is going to change the way we do deals in the country from here on. And to discuss that and much more on the perspective of the general direction given by the union budget this time around, we have two experts joining us on Big Deal this time, Zia Modi of AZB and Sanjay Nair of KKR. Thanks so much for joining us. Starting with you, Zia Modi, what do you think is the general direction given by the finance minister this time, and especially considering that we are in an election year? Is it in any way populist according to you?
So I think it has a couple of drivers. The first is clearly to enhance the standard of living and the ease of living, if you like, of the rural economy. The green gold of bamboo and the self-help groups being increased further, all the directed subsidies in full flow, and all the other schemes to better education, to now make all the APMCs redundant at a state level and allow the farmer to market directly through the e-portal. I think what the finance minister is trying to suggest is that the concentration now of the allocation of funds is going to be on rural and agrarian India, to see how they can increase not only their standard of living, but then everything else that comes with it.
Sanjay Nair, what do you think about the macros, the fiscal slippage and the prudence there that is one of the worrying points even for the markets, and therefore the mayhem that we saw?
I think the finance minister is trying to create it's kind of a social security net, which we do need because a significant part of the population is pretty underprivileged. So I think that's the broad direction. I think that the budget willy-nilly does mean that it is going to be propelling consumption if it's executed properly, which is fine. I think it could be mildly inflationary, because there isn't much here that tells me that capacity is going to be matching up to it. So consumption picks up, we're going to be mildly inflationary. So I think with those two things in mind, I really think the big joker out there is, do we meet the fiscal maths for the next fiscal? And I think he's taken a reprieve at 3.3, but even for 3.3 to come right, again, I'm not the mathematics guy, but I think that is an issue which one has to watch out for.
But Sanjay, fiscal discipline is one thing, but the long-term capital gains tax is another, which has really worried the overall equity markets, and it really fell on Friday. So what do you think is going to be the general direction that the equity markets will take from here on? And in particular, how will the private equity world really take this kind of a development, especially with their returns really taking a beating after this tax?
I think long-term capital gains are everywhere. I think to an extent, we have all been, I won't use the word, but there's no better word than saying we've been spoiled for a long time. You have long-term capital gains everywhere. Yeah, we don't have STT and this. I think over time, this will also get rationalized, but the imposition of a 10% long-term capital gains is, I don't think, something extraordinary. And then I think it's been imposed in quite a non-disruptive way, in a way, vis-a-vis the January deadline. So look, I think on balance it's fine, and I think it brings us at par with many other countries.
Zia Modi, do you not think that there is more clarity required as far as the IPO of the unlisted companies is concerned in terms of figuring out the long-term capital gains tax to be paid? Because you do not have a reference point in terms of what is the value of an unlisted company on 31st of Jan till where the grandfathering of other equity shares has been done in terms of value.
I think you're right. It needs clarification. And certainly for the private equity, IPOs are an important part of the exit process. So I think that if the government intended to give 31st January as the right date, then the question will be, what is the value that you're going to prescribe of an unlisted company, and how will you allow that to be calculated such that you obviously don't want a situation as the government where you disadvantage PEs to the extent that wanting an IPO becomes unattractive. I think it will get clarified soon.
More clarity required. Sanjay, what are you going to do about this? Because last year was the full year of private equity exits through the IPO route. Is that now going to become less attractive for private equity?
I think there are a couple of areas that are a little bit open for doubt, and we intend obviously writing to them and asking for clarity, especially as it pertains to unlisted shares, because private equity normally invests in unlisted companies, makes them bigger, better, and then list them. So if that route is going to get clouded by this long-term capital gains with a reference price dating back before Jan, I think then that's a problem. So we need to represent that. If somehow we can get a valuation done of the unlisted shares for Jan 31, 2018, which there are many methods, and one can take any prescription for that, then I think we're in better shape. But yes, this is going to be a bit tricky.
Yes, Sanjay, but not just IPO market, even block trades through which the private equity firms have been booking their profits and getting their returns, that is also going to take a hit in terms of the returns. Do you think that private equity investments are going to now be taking a breather for some time? Or on the flip side, do you think that because the markets are now getting weak because of various reasons, there could be some sanity in valuations and there could be some buying then?
Yeah, look, I think the markets have had a very good run for the last 1 year. I mean, it's been up 30% in a year, which is quite remarkable and driven a lot by domestic savings. I think the market correction to do with the budget is what it is, but I think generally the markets have been overvalued given the inherent earnings profile. So, as I've always said even earlier on various programs, that we need to see the earnings power come back. So for me, the fundamental issue remains the horsepower that is there in the earnings of these companies, the pricing powers, the capacity utilizations, the private investment. I think that all needs to pick up to again see robust capital markets. Just driven by liquidity and short-term liquidity, that's fine. You know, some of it will go back, some will come back. People will do things between Jan and March to reset their prices. I think we should just declutter from all that noise and focus on is there improving depth and liquidity, which I think with the growth in the DFI industry there is. And I think foreigners will also come back if they find that on a macro basis, India is in good shape, which I think it is, and on a micro basis, the companies need to deliver earnings. And if that doesn't happen, then I think you're going to see stagnant markets, and stagnant markets, will bring us back into reasonable valuation in a year or so. So we'll see. I think companies who have to raise money, they have to raise money. So private equity guys who have to exit, have to exit. And as long as there is liquidity, they'll have to execute on the market. I don't think there's much choice there.
Zia Modi, coming to you on the IBC changes. Of course, there is relief coming in on MAT as far as IBC transactions are concerned, and also the relief and the waiver that was sought in terms of carry forward of losses in these transactions. So both those clarities have come in. How much of a boost is that?
So I think the government is clearly vested in making the IBC a success. And therefore, whatever are the real pain points that are coming up in the way it's unfolding, the government is listening hard, and moving, in fact, comparatively pretty swiftly. I see that there is obviously a lot of hiccups that we are seeing as lawyers and intermediaries, and all of them are, different. Each resolution plan has different issues. But my own view is that in the next 2 years or so, this will resolve. It has to resolve. The one thing that I think the government has taken a position on, rightly or wrongly, is that I don't necessarily want the best price. I want the honest price, having taken a judgmental view on the promoters. I think there is going to be less revenue collected in terms of make-up value, which promoters could probably give. but that right now is water under the bridge. I think the banks are having a fairly tough time in really having to deal with so many resolution plans at the same time. There is bandwidth, there is capability, capacity, and frankly, still a fear that their actions taken in good faith could be met with questions from the CVC, etc. So I think the ring fencing of the bank officials, especially the PSU officials, has to again be something that the government keeps discussing and deliberating with them, because it's time that our seasoned veteran bankers were taking decisions that benefited the whole process, and just ping-ponging it to the resolution professional, etc., may not be the best thing if that's what you're driving them to do. So let's see, but I am extremely hopeful that this is going to be a success.
Well, the entire complication of this process has kept many investors out of the ambit of the entire NCLT transactions, Sanjay Nair, you were very keen on the stressed asset space. You have even spelt that in various fora that you are interested in this space, but you haven't really actively involved yourself in any of the transactions. Any particular reason for that?
I mean, look, firstly, we are participating. So it's not that we have not participated in various transactions. We'll see when the results come out what happens. I think the key challenge for us, again, is we've got our ARC license now. We need to think about a strategy going ahead. And the way we're looking at this is that completes our toolkit in terms of having another, vehicle with us which can participate in debt aggregation and doing all the right things. The key challenge is to find the assets at the fair market price or the fair clearing price. And the banks, I think, are now beginning to see that there's a lot of sense in doing bilateral pre-packed deals before going to NCLT, because you do to an extent lose control once you go into NCLT. I think we will see better deals happening which can give banks cash, which can give them an option to earn over time, because our intent is to take these assets and hopefully resolve them and make them better and not strip them. Contrary to what people think private equity does, I think we intend actually resolving them and looking for those businesses that can be revived and create equity value, which have suffered for different genuine reasons. So I think we're going to look at this pretty seriously. The IBC and the NCLT is a great process. It has now instigated the banks to finally act, which is good.
CM Modi, there's one more statement that the finance minister made about SEBI to mandate the banks, the companies, to really have 25% of their total borrowing in bonds. Do you think that can be something that can be made a compulsion that can really throw the entire corporate finance of a company out of tizzy?
I'm not sure the companies think too well of that as the market has disclosed. But again, we'll have to see the fine print. And, on what basis are you forcing this proposition? How is it going to really impact on the cost and the fundraising ability of the corporates? Side by side, he said that, people should allow bonds which are rated A as opposed to AA. But what happens to the people who are not even A? But they can raise money from other sources in the market. So have you really thought through how everyone down the line would be impacted, and not just the better top rung of corporate players?
Well, we'll look at that, but there's one more aspect legally, that is the definition of business connection that has also been changed. Is that going to impact, Sanjay, your business or the business of other private equity firms in your view?
Well, I hope not. I think that's a clarification we will seek again, although, the people we have spoken to, it looks like that is never the intent. The intent was to try to bring into the net multinationals that may be closing a contract overseas and then outsourcing it to their own subsidiary in India to do the work. And I think the intent here is to try to capture that income into business income. I think private equity is already covered adequately under the Permanent Establishment Tax, and we guys are following all the new rules now. I think this was meant really for contracts done overseas and that are executed here by the firms, and those I think that they want to capture, which probably makes sense. But again, I think the devil is in the details, so we must get the clarification on this.
All right, so some bit of clarity required there from the legal mind. Zia Modi, how do you read into this change and the change in definition and the ambit that has been really widened on business connection?
So basically, if you have a situation where a set of people in India or an organization or a company in India is seen by the tax authorities to really be the main business pot of what a foreigner is doing, then I think that they are willing to stretch themselves and say, you constitute the business connection of the foreign entity. We are going to treat you as if you were the arm and legs of that foreign entity, and therefore whatever tax is attributable from the income of the foreign entity, we want a share of that in India.
Zia Modi, coming to you, there was also a mention of hybrid products for fundraising. Where have we reached in terms of that policy, and could it become a good source of fundraising at a cheap cost for corporate India?
Yeah, I think that should be interesting. I think from the budget speech, at least the finance minister sort of suggesting that the focus will be to help startups and venture capital. But if hybrid instruments come throughout, it can't hurt. So already the market has evolved several types of hybrid instruments, but they all have to conform either with the external commercial borrowing policy or what the Reserve Bank is allowing the NBFCs to do in terms of the NCDs. Warrants, partly paid instruments, pricing guidelines from a FDI perspective for these instruments. I think all that, if the government thinks through, consults with the RBI and the market, I think that could be quite attractive.
Now, Sanjay Nair, you would agree that with very little done on corporate tax bit only for smaller companies, there is very little in this budget for overall corporate India. How do you think that corporate India's confidence is really going to come back, and when is private investment going to pick up?
I think private sector investment is still low. Private sector confidence, however you classify that word confidence, is still low. But I would say that the private sector will have to really step up and take a long-term view. Because in a way, private equity takes a long-term view and it backs Indian entrepreneurs. And unless the Indian entrepreneurs step up and make investments in real asset creation, then private equity is going to keep doing just refinancing of either debt or other private equity. So, we would all love to see real asset creation, new asset creation from the private sector. So if this program that the government has announced broadly, hitting healthcare, continuing on infra, rail modernization, massive focus on education, if these are implemented well, I think there will be enough private sector opportunities in all these sectors to kickstart them to participate. But look, time will tell. Private sector has to step in. And if they step in, I think we'll have more opportunities.
All right, Sanjay Nair as well as Zia Modi, thanks so much for joining us with your views and expert takes on how budget really changes anything on the deal street. Thanks so much for joining us. All right, so on the end note, there is some clarity sought, especially on the LTCG levy on IPO companies. How will that really pan out? And of course, private equity funds are going to seek clarity as well as some waiver also from the Ministry of Finance is what I gather. So some clarity required on that, and also on the definition of business connection is something to be watched out for. How will the markets really behave? Will the LTCG cost really haunt the markets? And how will the ECM transactions, the IPOs, as well as various other transactions go ahead in a weak market? We'll have to see that and deal with that in the coming days. Stay tuned to CNBC TV18. Thanks so much for tuning in.